Hi everybody, this is AJ speaking. Today I wanted to discuss Alphabet, aka Google. The company closed yesterday, August 1st at $189.95. Stock is down 2% over the last 5 days and sold off yesterday 1.5% in a generally quite negative market. In this presentation I want to walk you briefly through the company's second quarter performance. Then we will be looking at the current consensus estimates, from which we will be deriving a earnings projection. Then we will be looking at implied multiples, and then we use the earnings projection and multiples to derive a share price corridor to find out whether there is opportunity for investors. So let's dive right in. So on this first chart we look at total revenue development. The second quarter of 2025 came in at $96.4 billion. That's up 14% year on year, so quite strong growth. Please note that this implies that Google has now grown for 8 consecutive quarters double digit. Double digit means at least 10% year on year. By the way, throughout this presentation I will use the names Alphabet and Google synonymously. Technically, Google is only one part of Alphabet's business, but I think most people know the company on its original name, which was obviously Google. Next, let's look at gross profit. Gross profit was up 17% to 57.4 billion, and gross profit too grew for 8 consecutive quarters, at least double digit. So very strong growth. Google's gross margin improved 1.4 percent points year on year to 59.5%. That's the second highest quarterly gross margin in several years. Operating expenses increased 20% year on year to 26.1 billion. This already gives us some signal what is happening right now within Google, but I will discuss this in a little bit. That resulted in OPEX margin to deteriorate by 1.3% points year on year to 27.1%. So this is an increase in OPEX margin. An increase is a bad thing. An increase means you're spending more cents per dollar of revenue on operating expenses. This is also the least efficient OPEX margin in 6 quarters. It marks the highest sequential increase in over 2 years. Sequential increase was, so quarter over quarter, was 1.3 percent points. And the last time such a large increase happened was in the first quarter of 2023. This gives us more indication of what's going on in the company. Now let's break it down into what is actually driving operating expenses. This is what you see on this chart. This splits operating expenses into the 3 main buckets, which are number 1, research and development, second, sales and marketing, third, general and administrative expenses. You can see how sales and marketing stayed relatively flat. Also, general and administrative expenses stayed relatively flat. But the cost driver that went virtually through the roof was R&D expenses. So now the plot thickens. Alphabet is significantly investing in R&D, and they've been spending 13.8 billion in a single quarter, this was second quarter of 2025, on research and development. That's obviously a huge amount and makes them one of the largest R&D spenders globally across any industry. So this gives us already quite a bit of insight as to what's happening in the company. Something must be going on, otherwise they would not be pouring so much money into R&D. Next, we looked at the exact same metrics, but this time on a relative basis. So we express each expense driver as a percent of total revenue. And you can see that R&D accounts for 14%. Sorry, I have to put it differently. Google spends of every dollar earned, so in terms of revenue, they spend 14 cents on R&D. They spend 7 cents on sales and marketing, and about 5% on general and administrative expenses in the second quarter. So the key takeaway from this chart is that R&D spend on a relative basis, relative to revenue, increased moderately if you look at this from a long-term perspective. But the other 2 expense buckets, sales and marketing, general and admin, both saw a, let's call it, modest downward trend or improvement. So it's good to see the company is becoming more efficient, but R&D is increasing relative to revenue. And I think it's worth pausing on that point for a moment, because the typical, let's call it business school theory, is that as a business gains scale, it becomes more efficient, because overhead expenses and other expenses can be spread over a larger larger revenue base. So in relative terms, and this is what this chart shows you, you would expect these efficiency ratios, let's call them, to come down. This is what we see only slightly in the sales and marketing and general and admin bucket, but R&D intensity is actually seeing an increase. So I recommend to keep this in mind whenever you model a company. The efficiency ratios that you're forecasting may not actually materialize. Next, let's look at operating profit. Quick recap: operating profit is when you take your gross profit and you deduct operating expenses. Operating profit is up 14% year on year to 31.3 billion. And the first half of 2025 is up 17% to 61.9 billion. Operating margin improved 0.1 percent points to 32.4%. That's also near long-term highs. So profitability is quite strong by Google standards. Net income was up 19% year on year. The significant spike that you see in the first quarter of this year was driven by a non-cash gain Google booked on its, mostly from its SpaceX investment. So this is something to keep in mind in Google's earnings. They make very few adjustments, and they show in diluted earnings a lot of these equity gains that are, again, non-cash items. But of course, in theory, they could sell these stakes and generate income. But that income, that release of capital upon sale, would of course be one-time in nature and therefore not factor in adjusted earnings. And this is a big reason why Google almost always beats analyst estimates when you just look them up on mainstream media, etc. Because what journalists do, they compare the consensus estimates that of course do not project equity gains with Google's reported EPS that does include the gain. That just is something to keep in mind. Then we look at net income margin, also near all-time highs at 29.2% in the second quarter. Again, the spike in the first quarter was driven by this just mentioned one-time or SpaceX gain. Now we look at cash flow. So what you see is in front of you is operating cash flow came in at 27.7 billion. That's up 4%. You can see already this is quite a difference between the high double-digit revenue and other profitability metrics that we have seen. I mean, their growth. Then we move to capital expenditure. This is where it gets really interesting. Again, capital expenditure is where all the AI infrastructure investment sits. And you can see capital expenditure, or CapEx for short, is going through the roof. It's up 70% year on year in the second quarter, and Google spent 22.5 billion on CapEx. And the first half is already at 40 billion in CapEx, and this is up 58% year on year. So this is another breadcrumb that leads us to what's going on in the company. So the first one was that something was happening with R&D expenses. It was increasing significantly in absolute terms, dollar amounts, but also slightly on a relative basis as a percent of revenue, number one. Number two, we see CapEx going completely through the roof. 70% growth is wild. But let's move on. Now let's look at free cash flow. Just as a recap, free cash flow is what's left when you take operating cash flow and you deduct CapEx. So you look at this number, 27.7, and you deduct 22.5 billion. The residual is 5.3 billion. In other words, your operating business, so the core of your business, generated 27 in cash, but then you reinvested in a business 22 billion, and the leftover is what you see on this chart, the free cash flow. This is one of the most important metrics in any business, and you can see the second quarter came in at the lowest level in several years at just 5.3 billion. And it's a decrease of 61% year on year and 72% quarter over quarter. This gives you yet another clue what's going on. So the CapEx increase was not just in line with sort of the increase of the cash flow of the company. No, the company did heavily lean in on investing in AI, reflected in a huge capex number, they were willing to deplete not all, but we could say most of the free cash flow. Most of the operating cash flow they were willing to spend on investments in AI. The R&D spend increase also reflects the increased spend on AI. So the compensation packages for AI talent would be reflected in R&D spend. But the breadcrumbs don't stop here. So let's look at financing cash flow. So financing cash flow shows you whether the company net returned capital to capital providers, including both equity providers and debt providers. If the financing cash flow is negative, as was for the last several years in Google's case, it means that the company returned more capital than it raised from equity holders or issued to debt holders. In Google's case, that meant mostly share buybacks, since Google's debt balance remained quite stable for a long time, but we'll look at it in a moment. So what happened is, because of this enormous investment in AI, Google decided it was better to dial back share buybacks and raise debt. I should point out, thus far, Google touched share buybacks only a tiny bit. So share buyback is still quite high. So the reduction in negative financing cash flow comes mostly from a net issuance, so increase in debt, but we'll talk about it in a moment. And the number that you see, the negative financing cash flow, this negative 5.8 billion, is not an accident. Because when you compare this number with free cash flow, these two numbers are remarkably similar. And we get to why now. This shows you the cash balance. The cash balance stayed constant. It came in as of the end of June at 95.1 billion, which is a tiny bit down from 95.5 billion, so just 400 million less, which is rounding error in Google's case. So what management decided to do is they said, okay, we have this amount of operating cash flow. We have to spend this much this quarter on AI infrastructure and other capex. We have about 5 billion in free cash flow left. So let's not touch the share buyback too much, because shareholders would get potentially worried. So let's do instead a debt raise so we can keep the share buyback going. We just reduce it a little bit, and also helps us to maintain our high cash balance, which our shareholders have gotten used to. And because we have a super solid balance sheet, we can easily do that. I think that was pretty much the boardroom discussion. Of course, I'm simplifying and obviously in a nutshell, but this is exactly what the numbers tell us, and you can see this also very clearly once we look at the debt amount. So for a very long time, Google maintained a quite stable amount of debt, and over the last couple of years, continuously quarter over quarter, slightly reduced it up until this quarter, second quarter of 2025. Things changed, and the company decided to raise nearly 13 billion in debt. So the debt balance increased from end of March 10.9 billion to 23.6 billion end of June. For the reasons that I just pointed out, they wanted to make sure the cash balance doesn't drop. They wanted to really lean in on AI investments. They didn't want to cut meaningfully the share buyback. So to basically achieve all these goals, the only option, or what they had to do, was they had to raise what looks like a large amount of debt, in fact isn't for Google. And that's why we need to look at what's called leverage ratio. And that's what you see on this chart. So first of all, what is leverage ratio? Leverage ratio expresses the amount of debt relative to another metric. There are different kinds of leverage ratios, and they all have slightly different objectives. The leverage ratio I'm using here is quite a harsh one, because this leverage ratio takes debt divided by capital, and capital is defined as hard capital, meaning you take total equity, you take the debt, also part of the capital structure of the company, but you take out all intangible assets. And this also includes goodwill. And Alphabet has quite a bit of goodwill from tons of acquisitions they did over many years, and some small amount of intangible assets. So what's the outcome of this? So the bottom line is, before they raised in the second quarter this 13 billion in debt, at the end of March, the leverage ratio was at 3.4%. Debt is very, very low. But now, after the 13 billion debt raise, it increased to 6.7%. This is still very I mean, this is still low. It's not super low as it was before, but it still would be considered relatively or quite low. And if any S&P or Moody's analyst, ratings analyst is listening to this video, will most likely agree with me. But now the more interesting question is, how much room would they have left? And the answer is quite a lot. Here on the right side, amongst the bullet points, I just put down some example calculation. If the company was to raise another 20 to 50 billion, the leverage ratio would rise to just under 12 and slightly above, or at the higher end at 50 billion, to just over 18%. That is not very much. This would be considered, this would not, at 18%, this wouldn't be low anymore, but this would be like more medium type leverage. And the reason is simple. The company has just a very strong balance sheet, which they never really used, and now they just started using it, and that's why they still have ample debt capacity left. But the big picture is it's another indicator that something has changed in the company. So let's summarize again. So we have seen the R&D spend going through the roof in absolute and relative terms. I mean, relative terms not so much, but it's also increasing. CapEx is absolutely going through the roof. Company is willing to increase debt leverage, is issuing long-term record amounts of debt. So my takeaway is that Google has now entered full-blown the AI race. I think ever since they watched Meta go absolutely wild on AI investments, Microsoft constantly increasing their AI investment, and watching the pressure on their market cap, the relatively low multiple as we get to in a moment, they said, heck, we need to do something. And they're now really ramping up. So next, let's talk about earnings. So what you see in front of you in this dark blue color is actually reported EPS numbers. So this diluted EPS. Throughout this presentation, I will only be talking about diluted EPS, since basic EPS is useless for valuation work. So what you can see here, again, this massive spike here was caused by Google not adjusting for certain what I would consider one-time items. So you have to keep this in mind. So the second quarter, that was just a little over a week reported, came in at $2.31, beat just like the last 4 times analyst estimates. It's an important consideration because these forecast EPSs are based on, first of all, consensus up until 2026. Then from 2027, I extrapolated earnings at a 10% annual growth rate. It's actually meaningfully ahead of the growth rate consensus currently implies. Current consensus implies a just under 6% year-on-year growth rate. And the reason why I'm extrapolating post 2026 is right now I don't have a 27, 28, 29 consensus. You may ask why I haven't tried to make a forecast myself. Simple answer is I simply didn't have enough time, because this is making a reasonable a reasonable estimate takes enormous amounts of time. But stay tuned, this will come in the future. And the companies I cover, in most cases, I beat consensus. But just like everyone else, I occasionally miss, but overall I outperform Wall Street. But to make these EPSs useful for valuation work and then for share price projection, etc., we need to turn them into an annual number, because valuation is always forward-looking. We need to generate a next 4 unreported quarter metric. So we now leave these quarterly EPSs and move to these EPSs. So this is always the next 12 months. And with this step, not only we are moving to a next 4 quarter metric, but also we are changing the scale on the chart. We're now moving to the reporting months, because ultimately for valuation, not the financial quarter end matters. It matters when a quarter becomes knowledge of the market. For one, the market to price in what was achieved, but also for the reset of the community based on the just reported earning. So that's why when you try to work out multiples, etc., you always need to make sure you're always matching earnings with the share price reaction. So for example, the company reports after hours, so you need to take into consideration that the closing price on that day is still undisturbed. So the first disturbed share price is the one after the reporting date, not the reporting date. So let's look at these next 12 months or NTM EPSs. So in this dark blue color, this is actually reported next 12 months EPSs. And because we need 4 unreported quarters, you can only show it up until up to the reporting date in last year, in July. Since from July last year, we have the third quarter of 2024, the fourth quarter of 2024, the first quarter of 2025, and now the second quarter of 2025, so 4 quarters. But after the July 2024 reporting date, so that's October 2024, we have only 3 actual unreported quarters from the company from that vantage point. And that's why we need to supplement them with an estimate. And this is what's shown in this, it's called greenish color. And that's why this is labeled blended. So it's a blend of actual and consensus estimates. Keep that in mind. And then this purple color shows you when the next 12 months EPS is fully based on consensus. And you see here July is colored because this is always the next 12 months EPS right after the quarter was reported. So Google reports end of July. So at the end of July, this 10.15 $1 per share is the next 12 months EPS right after the reporting date. And then this light blue color shows you extrapolation. Since, as I said, I only have forecast till 2026. So from the April first quarter 2026 reporting date, I have only 3 quarters left. So I need to supplement the consensus with extrapolation to create the earnings outlook. But keep in mind, look at these yearly growth rates up here. My my simple extrapolation is ahead of what consensus currently implies. So now we got a step closer to a valuation metric, so a next 12 months earnings metric. But the problem is we want to project share prices, and share prices occur not only once per quarter, but every day except weekends, of course. So let's change the view of this chart and just look at these numbers. They are the same here on this chart. So this chart is the exact same as this chart, but now we show this on a daily scale down here, and these thin bars just mark the day when the company reports. So these are all the quarterly earnings. But now we have a problem between each reporting date. There's a gap. We need to fill that gap. So we can forecast, make a daily projection. This is just a technical slide. This doesn't add or subtract anything from the implied valuations we're going to look later. I just want to demonstrate how you go really from the forecast, quarterly earnings, next 12 months earnings, down to the daily forecast, so that you see this is all based on a consistent approach, but also how we can improve on the classical approach. And this is what we're going to look at now. So this is what's called a snake chart. And when you have growing EPSs, you have this kind of staircase pattern. And in finance, in investment bankers, they always will show you this type of EPS chart when they do a pitch to you. And there should be, or there might be somewhere in the main part or in the appendix of the book, something that looks like that. And this is what I would call the classical approach. This is how bankers have been doing this stuff for probably well over 20 years at this point. But this has a couple of downsides. So basically what this chart does is it updates the next 12 months after every quarter. As a quarter is being recorded, the next 12 months move forward by 1 quarter. And so so in this forecast that has 4 quarters, the next upcoming quarter, that when it's reported, drops out of the next 12 months, and then another quarter is added to the next 12 months. And what this classical approach does, it keeps the next 12 months EPS constant, and that's why you see these flat lines between each quarter. And then it jumps up every time the quarter is reported, and the NTM moves forward in time by 1 quarter. The issue with that is that it slightly understates the NTM, and a slight understatement in the earnings creates some inflation in the multiple. Because remember, price divided by earnings is the multiple. So if the earnings go down or slightly lower, the multiple goes up. But there's a simple way we can fix it. And this is what you see on this chart. So this chart linearly extrapolates between two reporting dates. So this is a very simple approach, but it improves the multiple. And it's based on the following assumption. As the upcoming earnings release comes closer and closer, greater and greater certainty about the to be reported earnings is being priced. In this video, I will not discuss this approach in too much in detail because this would take too long, but I left you some clues why this is a superior approach here in the bullet points, so please feel free to pause the video and read through them. But I think it's intuitive. I think it's intuitively sensible because the fewer days are left until reporting, the fewer things can happen, bad macroeconomic prints, less opportunity for key customers leaving, etc., etc. But again, this would be a topic for an entire video by itself. So the key thing here is, so that's the earnings curve that we're going to use to project the share price. But just to recap, we started off quarterly earnings. We turned them into an annual metric because you need always an annual metric for any kind of multiple. We smoothed between two reporting dates linearly to get a daily next 12 months metric. And the result of that is this curve. The second ingredient we need to make a share price projection is we of course need a valuation metric, and we're going to use, as I mentioned before, a next 12 months PE ratio or a forward PE ratio. These terms mean all the same thing. So let's do a quick trading level review for Google. So this chart shows you the trading level for the last 8 years. And you can see that the stock was bouncing around from, let's say, as low as around 14 times. This was during COVID, all the way to just over 30 times. And that was driven by, of course, the COVID recovery rally, COVID checks, the Fed printing money, the significant rise of Robinhood investing, etc., etc. So there was just a lot of money sloshing around in the financial markets, boosting pretty much every stock's. And then, of course, there was followed by kind of a crash, and this is also what we see in the implied multiple. Again, this is not a share price, this is a multiple, what you see in this chart. And you see the significant multiple compression, and that was driven by a couple of factors. Of course, first of all, the Fed was hiking rates at a record rate. That created a sell-off in the market. Google couldn't maintain its high multiple. So this started a re-rating from, just mentioned, above 30 times. 32 times PE, that the stock held only very briefly. So let's talk about 30 times PE. And then it dropped down to around 25 and held that level for a couple of months until the ChatGPT moment happened. That was at the end of 2022, fourth quarter of 2022. And people and investors really quickly realized that this might be an existential threat to the Google business model. And then the stock saw a significant multiple compression to a level that the stock only saw, and this is an important observation here, only during economic crisis. And this is, for example, when you look at this chart, you can see that the level is, the trading level dropped to is only comparable to the worst part of the COVID sell-off. And that happened in the at the end of the first quarter of 2022, and then during the summer of 2022, and then in late sorry, I misspoke. The COVID crash happened at the end of the first quarter of 2020, and then the recovery started at the end of 2020. And during this time, the trading level in Google dropped to a level that is somewhat comparable to the current trading level, but it was slightly lower by approximately half a multiple. The other thing to point out here is these, first of all, the black line is the median multiple over the last 12 months. But the line is here shown over the entire last 8 years. The reason for that is it helps to compare prior years with the current last 12 months trading level. So when you look at this black line with this in mind, you can see that in the prior 7 years, or I should say prior 6 years, so before 2023, before the ChatGPT moment really hit hard, the stock always traded above that level, except during the COVID crisis. When you look to the trading level before the COVID crash, so when you look at the years 2018 up until the beginning of 2020, the stock was mostly trading, just by eyeballing, we can see around 25 times. And then we had the post-COVID bubble that we just discussed, due to money printing, yada, yada. And then Google got hit twice by the deflation of by the bursting of the bubble, plus ChatGPT. And this left us for the last over 2 years by now at a relatively narrow trading range around the, call it 17 and a half times 12 months forward multiple. Here on the right side, you see the exact numbers. So over the last 12 months, the median multiple was 17.3 times. At time of this presentation, the stock trades at 18.7 times. So the stock is, as you also can see in this chart, is above the median over the last 12 months, and it applies it's 7.6% over the median. This is not the share price, it's the multiple. Just want to make this very clear. So based on the trading level observable over the last 12 months, the stock would be overvalued right now, or not necessarily overvalued, but would be rather expensive, provided, of course, the underlying earnings projection is accurate. So let's move on from this somewhat ancient history and zoom in a bit. So this chart is the exact same chart, but now limited to the last 2 years. So we can see a bit more clearly the trading range. So the red and green lines, they always mark the 1 time and 1.5 times standard deviation around the mean. And you can see that recently, before the recent weakness in the market and the recent weakness in Google stock, the stock got slightly out of the 1.5 times standard deviation implied range, and then quickly pulled back. You can also see that in April, the stock was, I'd say, incredibly cheap, below 15 times earnings. I mean, at that level, I think you kind of have to buy the stock. But this is also past now. But the point of this slide is that over the last 2 years, even though, again, the black line, the median, is calculated just on last 12 months, so is the standard deviation, fairly consistently traded around that level. There were the occasional outliers, and I would highlight the summer of 2024. And then earlier this year, when the company reported a full year results, the company also had briefly a peak, a local peak, but then in the wake of the broader market sell-off, also lost that multiple and traded down to this, what I think incredibly low, 14.5 times. Now let's zoom in even one step more. Now we look at it just over the last 1 year. So this is the time horizon that was used to calculate the median and the standard deviation, as I said. And what you can see is there's quite a bit of volatility, and this is something we'll be discussing in a moment, but just keep that thought. So because volatility, if you're an investor, is a good thing, because volatility creates opportunity. But first, let's talk about share price corridor, price target, because I think this is probably what most people are interested in. And this is what this chart shows you. So first of all, what do you see? So this chart now shows you share prices. The purple line is the historical share price development. Stock closed on Friday at $190. And the gray shading implies the estimated trading range based on the earnings curve that we looked at earlier, that was derived from quarterly consensus estimates and the trading level, the PE ratio that we could observe in the market over the last 12 months, the median. And then the green and red lines indicate the share price range based on the standard deviation of the multiple over the last 12 months. So this last 12 months trading level then was applied to the last 8 years. 7 years. And you can see, and again, so this is fitted to 12 months by definition. And the key observations here is it's, of course, by definition, fits quite well for the most recent share price development. You can see the share price, except for these huge runs, is consistently in line with most trading days. And the interesting thing is, it goes even beyond 1 year. It goes, it fits quite well. So when you look back up until around end of 2022, the trading level that we have observed over the last 12 months creates a quite fitting share price corridor. But then, of course, as we go into this bubble period, the current trading level, based on these earnings that were generated at the time, again on forward-looking basis, were quite off. And because the reason is simple, the trading level was so much higher, the stock market was so much inflated, and therefore Google's multiple was so much inflated that when we apply today's observable multiples to these earnings at a time, the implied share price corridor is nowhere close to where the share price actually traded. And then when we leave this bubble period and go back to, let's call it a more normal period before COVID hit, you can also see that the current trading level does not project an acceptably accurate share price corridor. But yet again, this was a different time. This was when Google received a much higher multiple from the market, not a bubble territory multiple, but a higher multiple. So the big debate really is, can Google reverse the trend observable in the data over the last 2 years that saw a multiple in a rather unexciting, let's call it 17 plus minus 2 multiple range? And can it return to something closer to 25? Or is it going to be stuck there? My view is, I think it's going to be hard for Google to change the opinions a large number of investors have now formed about Google's positioning in the AI future. I think that there are several highly dangerous competitors, and I think Google would have to demonstrate meaningful outperformance over these competitors to change a large number of investors' now negative opinion. I think there's a psychological problem. Like in real life, if someone makes a strong first impression, you put that person typically in the good bucket, and also the opposite. And once a person is in the bad or good bucket, it's hard to get out. The good person that does something good just confirms your confirmation bias. The bad person who does something bad just confirms your confirmation bias. But then when the good person does something bad, you tend to ignore it. Oh, this must have been, outlier. And the same is true if the bad person does something good, you think this too was just an outlier. And I think, even though this sounds a little silly, this concept pretty much applies right now to Google. If they do something good, for example, their search product is enhanced via AI in a meaningful value add way, I'm not sure if investors are already prepared to give Google enough credit for that. And that's always the crux in the equity markets. Even if something might actually be really good, in terms of share price, it only matters if enough people believe in it being good. But I think that is right now sort of on a, let's call it meta level, the key issue. Google let perception slip into it not being considered the number one. And there was a huge, ginormous strategic mistake. And even if they start making, let's say in 2, 3, 4 quarters, the best AI products, it will take time to change investors' minds again. So anyway, these are just my 5 cents on this topic. It's going to be very interesting to watch how this plays out. But first, let's zoom in here a bit more. So now we arrive to what probably most of you wanted to know. Okay, is Google a good investment? Based on consensus estimates and based on where the stock was trading in terms of PE over the last 12 months, the answer is No, it's not an attractive investment. The market simply isn't assigning a lot of value to each dollar of EPS. So this methodology that I have now presented in, I think, great detail implies, based on median, only 1.6% upside over the next 12 months. This is unacceptable because the S&P 500 is expected to return a lot more than that, unless we have, of course, a market correction, which could be the case because we are trading right now significantly outside the normal valuation range in the market. But let's assume that's not going to happen. Then Alphabet would be set up to underperform, unless, of course, they could significantly outperform current analyst expectations. But what about a more long-term perspective? Here again, the implied return would be fairly lackluster. The return over the next 2 years, based on this methodology, would only imply 11.8%. But to make this comparable with a next 12 months potential return, we need to work out the compounded return. So year over year, that 11.8% would imply a 5.7% increase. Still not enough if you assume there's no market correction. And of course, if there's a market correction, Google would lose a lot more than the market because Google has a beta significantly above 1 times. So if the market, in theory, loses, let's say, just making random numbers, 10%, and the beta is 1.5 times, stock would decrease 15%. So the bottom line is, on a risk-adjusted basis, this right now doesn't appear to be a good investment opportunity. However, there are other ways to think about it. And for that, just take a look at these peaks and troughs in the share price again. They happen every few months. But to get a better sense of them, it's much better to look at share prices on a rebased basis. This is what this chart shows you. So a rebased share price chart is simply a chart that shows you every share price expressed as the percent change relative to a fixed share price. In this year, the share price from 1 year ago was fixed, and all subsequent share prices were compared to that share price 1 year ago. The beauty of that type of chart is you can just look at it and you can instantly see how it has moved since that starting point. So here the scale is in percent, and you can see here it ends, and the scale shows July, but the last day is 1st of August. And the stock delivered just over, it is about 12% over the last 12 months. So that's not very much, given that the market overall performed quite strongly over the time period. So Google underperformed. And given that the market currently trades at slightly over 22 times, which is significantly outside the normal trading range, should the market correct or a valuation level come down a bit, this provides limited opportunity for Google to reach a higher PE trading level, I think. Unless, as I said before, they can really demonstrate they are really becoming undisputed leader, or it becomes clear they will be one of the undisputed leaders in AI. But I think this race is far from over, so it's probably will take years to play out. So in terms of opportunity for investors, the key observation of this chart really is that when you look at these peaks and troughs, you can see there's roughly a 30% delta from a trough to a peak. So what investors could do is they follow the trading level closely, and when the stock pulls back to absurdly low valuation levels, as it has done several times in the last 2 years, enter a position. And then as it runs on new product releases, exit that position. My base case is that going forward, there will be an ongoing kind of tug of war between the bulls and the bears. And this will cause ongoing volatility. And because fundamentally, I think it's a good business, downside, I think, is protected. Because I don't think Google will just yield the AI race, because they have enormous financial firepower and can, just like Meta, just start poaching key AI talent with enormous comp packages. Plus, Google is arguably one of the best positioned companies in terms of building, managing large compute infrastructure, because this is something they've excelled in for, at this point, decades. And their in-house TPU technology also creates some interesting opportunities in terms of providing low-cost inferencing, for example. So bottom line of all of this, I think this is an interesting opportunity. This is not necessarily a company that I would right now take a position, hold for a long term at the current price, kind of fire and forget. This is something I would be monitoring for attractive entry points, and then observe the news flow and the hype around certain products, and then take profits as the stock gets a little out of the typical range. Going forward, this is a stock I will be covering more closely, and with my subscribers on X, I will be sharing analysis on potential attractive entry or exit points. Of course, this is not trading advice. I'm just trying to help share information to help you hopefully improve investment decisions. I know this was a very long video, but I hope that was helpful. Thanks for listening. See you in the next one. Bye.